Welcome back to the channel, everybody. I wanted to hop on this morning or this afternoon, whenever this finally posts. But we've had a morning where everybody's, in the red, and, all markets are really in the red. And people are just kind of wondering what the heck is going on. So I did want to hop on and kind of play crypto therapist for you guys, give you some insight into what's happening and kind of how to look at what's going on. So I do want to jump over to the charts first of all. Bitcoin actually earlier this morning dipped all the way down, as you can see here, almost to 89 flat. But we've kind of bounced off that, and we're sitting at about 92,000 now. But the rest of crypto is down, pretty bad. Bitcoin's down 2.51% at the time of recording. Ethereum's down 7.8%. Solana's down 6.6%. And so on and so on. But guys, here's what's actually happening. This isn't just a crypto thing. The entire Wall Street markets are down as well. And this is the reason. If we look at the DXY, guys, the DXY has just been on a tear. We actually hit over 110 on the DXY. So the dollar is strengthening. The dollar's strengthening. The bond yields are way up, guys. And here's the thing that you've got to understand: the Fed, with all these economic data coming out, with jobs being good, inflation probably ticking up. We'll see that this week, most likely. But we had really strong economic indicator or economic numbers coming out today. And so the Fed is, or not today, but, over the last month or so, we've had strong numbers coming out. We've had the Fed at the FOMC, Jerome Powell saying that we're probably not going to need to cut as many times as we thought. And that's really what kicked us off into this dip that we're seeing ever since December 18th. Was when we had that FOMC meeting. But they might not cut, guys. They might not need to cut, but they will. They've got to increase global liquidity, or at least U.S. liquidity, because they do not want this dollar sitting right here, and they especially don't want bond yields at the rates that they're at right now. Because listen, the U.S. has $36 trillion worth of debt, right? So that's our national debt. They've got $36 trillion worth of debt, and they've got to pay that interest at those bond yields. So they really do need this dollar to come down. The way they do that is they flip on that money printer. Now, it doesn't always come in the form of rate cuts. The Treasury can manipulate the reverse repo. There's all kinds of ways that they can inject liquidity and bring this dollar down, bring bond yields down, so they don't have to pay such high rates, such high interest on that $36 trillion that they're running. So there's just no way that they're going to let this continue. The markets are kind of jittery and scared because Jerome Powell is saying, with all this economic data that's coming in, this good economic data and higher inflation, likely we're not going to cut rates, but they're essentially going to have to do something. Listen, the government is in a pretty tough spot, and we've been saying this, or I've been saying this for the last year at least, because they're stuck in a really hard place. Before it was kind of, they didn't want to crash the economy, but they wanted to bring inflation down. Now they're at a point where they've got to bring down the DXY, but they don't want the economy crashing, and they continue to want to bring down those inflations. But I don't think that they can't, with the debt that the US government has spent, being that 60 or 36 trillion, probably really close to 37 trillion now. They've got two options. They've got either austerity to face and some big cuts, which I believe the Trump administration with the Doge committee, that's kind of their point, is they're going to cut unnecessary spending in the government, but they're not going to get, they might get a few billion if they're lucky, but they're not going to be able to cut enough to bring that national debt down. So they've still got that problem of bringing the dollar down a bit and bringing bond yields down. So the thing that's more likely, in my opinion, is they're going to have to accept a bit of inflation, which is good for assets, good for things like Bitcoin, good for real estate, good for, people who own things, and bad for people when they go to the grocery stores and when they're buying. I think we're a lot closer to higher inflation. I don't want to say hyperinflation, but hyperinflation works weird. It's very, very slow for a long time and then all at once. That's the definition of hyperinflation. And I'm not saying that's going to happen here in the US with the dollar being the reserve currency, but I just think they're in a really, really tough spot. And I think the easiest way for them out is to inflate the dollar a bit. Okay, so long story short, waking up today, I saw all the bears, saying, I told you so. But the bears that really, the strongest bear case is that we go into a recession. One of the biggest bears out there right now is Mike McGlone from Bloomberg. And he's been saying for a while, that we're on the precipice of like a 1929 Great Recession, terrible crash. The thing is he is so contradictory all the time. He woke up, this morning, I watched him this morning, and he was kind of gloating and saying, I told you guys we were due for a reversion. And yet the whole precipice of his case for this reversion, this 1929 style crash, is that the economy is going to crash. And we're just not seeing that with the economic numbers. If anything, the economy is showing that it's strong. So the bears out there are contradicting themselves today, which just kind of leads me to believe that this dip that we're seeing since the middle of December in all markets is really just kind of a shakeout, maybe a point of consolidation. I don't know. I want to jump over to another chart to show you guys another thing with crypto specifically, guys. And that is right here. This is a chart of the last 3 Bitcoin cycles, the year after, which is always an election year. The last 3 cycles, this has happened right before the inauguration of the new president. You can see right here, January 5th, 2017. This was when Trump was elected the first time. You can see we just fell way down here, all the way down, up from about 1,100 per Bitcoin. That's kind of crazy to even think about. 2017, but we crashed all the way down to below 750. And then, you know, the inauguration happened and things got back on track, you know, and we kind of continued up. And honestly, we went way up from here. We're looking at 1,000 area right here. We went up that cycle to 20,000. So that a 20x since that inauguration of Trump the first time. Middle one we've got when Biden was elected. We climbed up all the way, and then January 8th, 2021, 12 days before Biden was inaugurated, we had another big dip. This one went from 41,000 all the way down to, we dipped down to 29,000, guys, from 41,000 when Biden was inaugurated, or right before. And then, you know, February and March, we continued up, and we ended up hitting that all-time high, that cycle of 69,000. And now here we are again, guys. We've pumped up before January to that $108,000 high. And now we're kind of seeing this shakeout, this, you know, pre-inauguration dip. So guys, if that doesn't tell you, you know, don't be, you know, calm your nerves a bit. Remember your plan. There's nothing that has essentially changed, guys. This is just a strength of the dollar thing, bond yields going up, other market crap. But you know, what we do have, another thing coming up this week, I do want to throw back up TradeView. This week we have, let's see, Tuesday, we have PPI coming out, which is an inflation measure. It's forecasted, it's kind of strange right here. It's actually forecasted to go down according to the previous month, from 0.4% to 0.3%. And then Wednesday, we have CPI, core inflation. And this one, actually, some of these metrics seem to be going down, but inflation rate year on year seems to be is forecasted to be going up. And then we have core inflation rate month on month that is actually going down. So it's kind of mixed, things up in places, things down in places, but we've got 4 of these this week, guys. We've got inflation were the first 2, and then we've got retail sales and building permits here on Friday. This Friday, I believe, January 17th. Anyways, we've got a lot of economic data coming out this week, guys. So I would expect volatility, and it very well could be to the downside. It's not something I would trade, to be clear, and I'm not trading. But this week is that last week before inauguration, and historically we've gone down right before that, and then we continue on, guys. So the point of this video is just to calm you guys, to calm myself a bit too. We've seen this the last 3 cycles. Nothing out of the ordinary here, and nothing changes, in my opinion. So keep that in mind, guys. Always follow your plan, whatever your plan in investing is. But I don't think this changes anything about the 4-year cycle. I don't think anything in the charts is showing that we're now it's all over, you know, it's a bear market now. I don't think that's the case at all. So yeah, I mean, you guys got to do what you got to do for yourselves, but I don't think we're far from over, is what I'm saying. Okay, guys, so thanks for tuning in on this video. I do want to jump over here really quick. This is Chicken Butt Microsanctuary. This is the sanctuary that I'm really trying to shine a spotlight on this month. If you guys can donate anything to these guys, always appreciated on my part. They've got PayPal, Venmo, and Patreon here as it shows on this image. I do have all of those links in the description of the video, so head on over and help them out. I also have their Facebook and Instagram. If you can't afford to donate anything financially wise, and I understand that, even if a few dollars, if you can't do that, just go over to their social media and give them a thumbs up on some of their stuff. Really helps the algorithm and helps them gain more support that way. So guys, as always, very much appreciated for you guys tuning in to my videos, lending me your ear for the time being. And I will see you guys in the next video. Bye.